Now speaking, Melissa Napier, Head of Investor Relations. Good morning and thank you for joining us for Conagra Brands' fourth quarter and fiscal 2023 earnings call. Our CEO, Sean Connolly, and CFO, Dave Marberger, will be discussing our business performance and taking your questions when our prepared remarks conclude. We have made some forward-looking statements today, however, we cannot guarantee the results we will achieve. We have also discussed some non-GAAP financial measures which exclude items management believes impact the comparability for the period referenced. For more information on these measures, please refer to the earnings release and slides found in the Investor Relations section of our website. Now, let's get started with Sean Connolly. Now speaking, Sean Connolly, Chief Executive Officer. Good morning, everyone, and thank you for joining our fourth quarter fiscal 23 earnings call. We delivered solid profit and margin growth despite disruption from one of our frozen logistics partners, Americold. For the full fiscal year, we navigated a dynamic operating environment to deliver strong results. We executed against our fiscal 23 strategic priorities and implemented our playbook, positioning our brands well. Organic net sales grew over 2% compared to the fourth quarter of fiscal 22 and adjusted gross margin of 27%, representing a 216 basis point increase over the fourth quarter last year. We delivered on each of our fiscal 23 priorities, including disciplined pricing execution to drive margin recovery, improving supply chain to deliver service levels of 95%, reducing our net leverage ratio, and investing to maintain brand strength. Our pricing peaked in Q3 but remains almost 17% above the prior year due to our actions to offset ongoing COGS inflation. We took great strides to recover our gross margin in fiscal 23, and Q4 was our third consecutive quarter of strong margin improvement. We continue to advance our supply chain initiatives, investing to rebuild our own inventory. Our innovation has built some really strong and sustainable platforms, including Bowls, Slim Jim Savage, and Duncan Hines Epic. Our strategic frozen and snacks domains have grown 9% and 8%, respectively, outpacing total food growth. As we continue to emerge from unprecedented operating conditions, we anticipate fiscal 24 to be a transition toward a more normalized operating environment. We will benefit from the ongoing advancement of our productivity initiatives and our investments in innovation. We have seen a few single-ingredient brands become deflationary, and we will make appropriate price adjustments to reflect that. Our fiscal 24 innovation lineup features a compelling mix of convenient, value-added meals, restaurant experiences, and exciting licenses. We expect organic net sales growth of approximately 1% over fiscal 23, adjusted operating margin of 16% to 16.5%, and adjusted EPS between $2.70 to $2.75. We remain committed to our long-term financial algorithm and are positioned to drive sustainable growth and margin expansion. Now speaking, Dave Marberger, Chief Financial Officer. Good morning everyone. I'm pleased to report that Conagra has made great progress from this time 1 year ago. We successfully delivered on our priorities to implement inflation-justified pricing, drive gross margin recovery, reduce net leverage, and rebuild inventory levels, all while investing to maintain the strength of our brands. This enabled us to deliver strong full-year results that exceeded our original fiscal 23 expectations on all metrics. We delivered strong top-line growth with full-year organic net sales up 6.6% compared to fiscal 22, driven by our inflation-justified pricing and modest elasticities. Margin recovery was a top priority for fiscal 23, and our business delivered, increasing adjusted gross margin by 226 basis points and adjusted operating margin by 125 basis points for the full year. This margin enhancement contributed to strong full-year adjusted EPS growth of 17.4%. We estimate that our fourth quarter volume was impacted by the transitory supply chain disruptions from the cybersecurity incident at Americold, impacting revenue by approximately 50 basis points in the quarter. Despite this, we were pleased to deliver solid sales growth in all other segments during the fourth quarter. Refrigerated and frozen continued its strong operating profit and margin improvement in the quarter, with adjusted operating margin improving 286 basis points versus a year ago. Grocery and snacks operating margins were down 248 basis points due primarily to increased inventory reserves for excess seasonal inventory, along with unfavorable manufacturing overhead absorption. The international segment increased adjusted operating margin 497 basis points in the quarter, driven primarily by pricing, while the food service segment adjusted operating margins were down 75 basis points due to some transitory asset write-offs. Adjusted EPS from operations was flat as the increase in adjusted gross profit was offset by the increases in A&P and SG&A mentioned previously. Total EPS for Q4 was down 4.6% as the flat operating profit and benefit from our equity method investment earnings was more than offset by lower pension and post-retirement income, higher interest expense, and higher adjusted taxes. At the end of fiscal 23, our net leverage ratio was 3.63 times, down from 3.99 times at the end of the prior year. Year-to-date CapEx was $362 million at the end of fiscal 23, down from $464 million in the prior year due to the timing of projects. We paid $624 million in dividends in fiscal 23, up 7.2% versus fiscal 22, and we paid $150 million to repurchase shares in fiscal 23, up from $50 million a year ago. For fiscal 24, we anticipate organic net sales growth of approximately 1% over fiscal 23, adjusted operating margin growth between 16% to 16.5%, and adjusted EPS between $2.70 to $2.75. We anticipate net cost of goods sold inflation of approximately 3% in fiscal 24 as we continue to emerge from the inflation supercycle, with targeted inflation-justified pricing actions that will become effective in the early second quarter of fiscal 24 to help offset elevated costs. We also expect CapEx spend of approximately $500 million as we continue to make investments to support our growth and productivity priorities with a focus on capacity expansion and automation. Our board of directors approved a 6% increase in our annualized dividend from $1.32 a share to $1.40 per share. We are reiterating our commitment to the long-term financial algorithm we unveiled at our Investor Day in July 2022. We believe Conagra is well positioned for long-term value creation. Thank you for listening. Barclays analyst Andrew Lazar inquired, how do you see fiscal 24 unfolding in terms of volume and pricing, and what is your outlook for organic sales growth? Sean Connolly replied, yes, Andrew. As our CEO mentioned, we expect 1% growth in organic net sales dollars for the full year. This is based on the fact that we are transitioning back to a more normal macro environment and there will be a settling effect as the year unfolds. We anticipate this settling effect to be nonlinear due to supply chain disruptions and shifting consumer behavior. We expect volume trends to improve as the year progresses, although we do not provide guidance on volumes. Dave Marburger replied, Andrew, our guide of approximately 1% organic net sales is the result of a few different dynamics. We'll be wrapping on fiscal 23 pricing at the beginning of Q2, which will deliver stronger price mix in Q1, but slow significantly after that. We had supply chain disruptions in fiscal 23, with our Jackson plant in canning and then our Can-Meat recall, which will mostly impact the second half of the year. We have a strong innovation slate that has already started shipping in Q1, and we expect volumes to improve as we move through the fiscal year. There is some deflation in edible oils, pork, and dairy, resulting in lower prices on a few of our brands. We also have incremental merchandising and trade with strong ROI, mostly around brands that were supply constrained in 23. Lastly, we expect fairly consistent growth in our international and food service businesses during the year. J.P. Morgan Chase & Company analyst Ken Goldman inquired, what are customer inventory levels today and have you seen any abnormalities? Dave Marburger replied, Ken, our customer inventory levels remain consistent with historical levels. Price/mix for refrigerated and frozen was 10.4% and volumes were down 11.5%. Consumption was 2.9% for the quarter, resulting in a 400 basis point gap between shipments and consumption. This was expected, as we shipped ahead of consumption year to date in Q3. The Americold situation had a 110 basis point negative impact on volumes for the quarter. Morgan Stanley analyst Pamela Kaufman inquired, what pricing outlook do you anticipate for fiscal 24? Do you expect to take more pricing to offset inflation, and will you be lowering list prices across other product categories? Sean Connolly replied, Pam, thanks for the question. We have a large portfolio of products and some of them are made up of ingredients that are deflationary. We're seeing this in categories like oil, dairy, and meat products. Inflation is still present, but we're taking surgical pricing on select categories to offset it. We're also relying on productivity to help us tackle continued inflation. We're seeing it come down, but it's still with us and will require us to take some pricing early in the year. Dave Marburger replied, in Q1, we will see the effects of pricing taken in fiscal 23. We have communicated to customers that there will be pricing on our tomato-based products in early Q2 due to significant tomato inflation in fiscal 24. Sean Connolly replied, no, we don't see broad-based price rollbacks or downward adjustments across our product categories. We have seen some limited price changes in single-ingredient, pass-through categories. Morgan Stanley analyst Pamela Kaufman inquired, can you provide more detail on the 40 to 90 basis points of operating margin expansion? What is driving this growth? Dave Marburger replied, the operating margin improvement we guided to is primarily coming from gross margin improvement. Price mix, Q1 and targeted Q2 pricing are the key drivers of this improvement. We're also seeing productivity gains of $300 million, offset by negative overhead absorption and business investments. Additionally, supply chain disruption costs from fiscal 23 will be a tailwind to margin for fiscal 24. Evercore IC analyst David Palmer inquired, what is your outlook on frozen entrees, frozen vegetables, and popcorn, and how do you plan to drive growth in these categories? Sean Connolly replied, David, our frozen business has been a strong performer for us in fiscal 23. Despite some noise in Q4 due to Americold and consumer behavior shifts, we remain confident in the future of the space. Our share performance over the long term has been positive, though supply chain disruptions have made share gains more challenging in the short term. We are focused on premiumization in the vegetable category, rather than low-tier commodity vegetables. Across the food industry, there has been some softness in volume trends, likely due to a shift in consumer behavior as they stretch their budgets to cover other expenditures. We have factored this into our outlook and will continue to invest in our brands to keep them top of mind with consumers. UBS analyst Cody Ross inquired, do you expect to recover the lost sales from the Americold disruption in fiscal 24? If so, can you provide details on when? Dave Marburger replied, Dave here. We experienced disruption in shipments during May, resulting in a backlog that we had to catch up on. This caused a delay in shipments for Q4, which were then pushed into Q1. Sean Connolly replied, Cody, we experienced a period of time where we were unable to ship our products to some stores. This likely resulted in consumers being unable to purchase our products and instead opting for an alternative. Unfortunately, we are unlikely to recover this lost consumption. However, we are now past this period and are looking ahead. UBS analyst Cody Ross inquired, is it fair to assume 1Q will be the high watermark for organic sales this year due to 4Q shipments and wraparound pricing? Dave Marburger replied, Cody, as I mentioned, Q1 will have a big impact from price mix. UBS analyst Cody Ross inquired, what visibility do you have to the $150 million JV income guidance for the year, and what does that assume for wheat prices? Dave Marburger replied, we have a lot of visibility into Arden's performance and have closely reviewed their business. We are guiding to a level of profit that is consistent with their fiscal 22 results. Arden is a young, 10-year-old business that has made investments to grow their core business and trading aspect. We are bullish on the business and believe it has a lot of competitive advantage. Exane BNP Paribas analyst Max Gumport inquired, what commonalities have you seen in the shift of consumer behaviors that impacted the category of share? What data points suggest this is a short-term trend? Sean Connolly replied, Max, when we look at the data across the food space, we don't see an improvement in volume trends as prices roll off. The scanner data for the period ending 7-1 shows Conagra and our 5 peers are in the same place in terms of unit performance change versus a year ago. To get the noise out of the base period last summer, we should look at the unit volume change versus 2 years ago. We see an extremely tight band of down just over 6% in the last several periods, with no difference in the 13-week data and the past 4-week data. This suggests a shift in consumer behavior. We're studying it carefully, but it looks like people are cutting back and hunkering down to manage their budget, rather than trading down to lower-priced alternatives. People aren't eating less, so it's hard to imagine this continuing for an extended period of time. Goldman Sachs analyst Jason English inquired, what brands are you renaming with more targeted promotions now that supply constraints have been lifted? Do you expect promotional intensity to be enough to drive net pricing deflationary? Sean Connolly replied, we are okay with category-building promotions that have a positive ROI. We like certain holiday promotions because they offer an incremental opportunity to drive volume. We haven't been at full speed on some of those due to supply chain issues. We are not big fans of deep discount, low ROI promotions that train the shopper to buy on deal. We monitor competitive activity carefully and will do what's best for our business. We believe that innovation and marketing support are the best ways to grow categories and drive dollar realization. Goldman Sachs analyst Jason English inquired, is there anything that would suggest that the top and bottom line declines throughout the remainder of the year won't be as steep as expected? Sean Connolly replied, the simplest way to think about the year is that dollars and volumes will move in different directions. We are wrapping up pricing, so you'll see stronger dollars early on, then it will soften. Volume trends should improve as we wrap up pricing. We won't be guiding by quarter, as it won't be linear in terms of month to month or quarter to quarter. We have to get through the settling effect and drive the business for the long term. Bank of America Merrill Lynch analyst Peter Galbo inquired, Dave, what is the estimated free cash flow for this year given the dividend increase and leverage target? Dave Marburger replied, sure. We made significant investments in working capital in fiscal 22 and 23, resulting in our free cash flow not being able to pay down debt as desired. However, we are now in a good position with our inventories and service levels. We have guided to a net leverage of 3.4 times for fiscal 24 and expect to pay down debt with discretionary cash flow. Working capital is expected to be a slight tailwind for fiscal 24, with $500 million in capex and 90% free cash flow conversion. This drives our assumptions on debt paydown, dividend payout and other capital allocation decisions. Deutsche Bank analyst Steve Powers inquired, can you provide an estimate of the net wraparound pricing for the full year, the benefit from supply chain disruptions, and your assumptions on consumer behavior in 24? Sean Connolly replied, Steve, our diagnostic indicates that the current softness in the multi-category, multi-company environment is likely to be transitory. We anticipate headwinds in the first half of the year, but expect a return to more normal behavior as consumers adjust. There is speculation that this could happen as people get back to school in the summertime. We are not able to pinpoint an exact date, but have built in some conservatism in our outlook for the first part of the year. Dave Marburger replied, yes, Steve, I understand the desire for quarterly information, however, we are not providing it. I provided a detailed answer to Andrew's question that included information on guidance, disruptions, pricing and other factors. This should provide enough information to form a good estimate. Deutsche Bank analyst Steve Powers inquired, what benefit, if any, have you baked in for supply chain disruption catch-up and what is the net wraparound pricing on an annualized basis? Dave Marburger replied, I want to emphasize that the dynamics Sean discussed are the primary drivers of our pricing decisions. We don't want to get into exact volume and net impact on pricing at this time. Dave Marburger replied, we are guiding to a specific outcome and will remain focused on that. Bank of America Merrill Lynch analyst Brian Spillane inquired, what actions are you taking to manage the maturity paydown and reach your goal of a 3x leverage ratio by the end of fiscal 26? Dave Marburger replied, yes, absolutely. We are focused on paying down debt in 24. We have 88% of our debt fixed and 12% variable, so with interest rates increasing, it's pushing up the cost of that debt. We are motivated to generate discretionary cash flow and prioritize paying down debt to benefit our financials. Bank of America Merrill Lynch analyst Brian Spillane inquired, can you provide more insight into the working capital side, specifically inventory management, and how it will affect the tailwind you mentioned? Dave Marburger replied, we finished 23 with days on hand that we are comfortable with. We typically build inventory in the first and second quarters of the year, resulting in a seasonal increase in working capital. This is normal for Conagra. Stifel Financial Corporation analyst Matt Smith inquired, what is Conagra's elasticity relative to peers and how is it impacting guidance for the first half of the year? Sean Connolly replied, elasticity analytics measure consumer demand response to a change in pricing at a brand level. Our elasticity softened a little in Q4, but remained benign compared to historical norms and ahead of our peer set. Consumer behavior shifts are a different animal, not a response to a particular brand's pricing action, but rather a set of coping tactics to the overall higher cost environment, such as buying less for a period of time. To understand consumer attitude and how they are coping with higher prices, you need to look at more macro analytics. Melissa Napier replied, thank you for joining us this morning. Investor Relations is happy to answer any follow-up questions. We wish everyone a great day.